Hi, this is Joe Rabil. Going to talk about the S&P. I'm going to give some detailed characteristics related to breakouts and actually specifically go into candles or bars themselves, the individual bars, as opposed to looking at indicators or trends or anything. I think there's some important things to just kind of keep in mind and how that relates to what's taking place right now. And then I'm going to give an example. A subscriber asked about taking profits. I'm going to give a real life example of how I take profits for a trend trade, and then how that would differ for something if I'm going to look at taking a shorter term profit. So let's get into the charts and start with the S&P, and actually we'll go zooming in on the monthly real quick. Same pattern has developed here. There's no real major changes. We've kind of pushed our way up through the 50% retracement and the 62% retracement. I would view this as more of a normal, a neutral type of a pattern here. And we've worked off the oversold condition. 3,000 is still a pretty critical resistance area. But in the short term, we really haven't had sellers be able to take control. And I've been talking about that for a while. Let's go down to the weekly chart. And, we're trying to push our way through. The MACD is showing that it is above its signal line. So there is some signs that maybe we get this little crossover this week. And we're also showing that the weekly chart, the bar, is trying to work its way through the 18-week moving average. We still have the 40-week up here, up at 3,000. That could still provide some resistance. But there are some characteristics that I'm really looking for. I've got the daily up. I actually am going to skip the daily for now because I'm going to spend more time on the daily in a minute. Let's look at the hourly chart. And I think it's important to recognize that we've talked about the break of the trend line back here, and that we tested the high and then we came down and broke down. I circled the area that was the 1, 2, 3 change of trend to the downside, and notice that I circled that area. It was a single bar that was below the breakdown level. And then look at what happened at the peak. We have basically a single bar that there were more bars that held above, but the reality was there was no follow through on the breakout bar. So we can go and look at the RSI, and I pointed out back on the breakdown point. I've got this circled area where it was oversold on the breakout, and then when it was, on the breakdown, it was sort of oversold, and then on the way up, it was somewhat overbought. I think if we look at this breakout, this pattern right here in this bar, I would consider that a good signal. I'm going to zoom in a little bit. If you notice what happened, we rallied up. Now, on this move right here, where this took out that high, that bar breaking above this red line, this red horizontal line, I do not think that was a good signal because it was overbought going into it. But we got a pullback and then broke out. And that was a pretty strong bar on the hourly. Let me zoom in a little bit. And, you had a pretty strong bar to the upside, and you could have put a stop underneath this red bar underneath. And you'd still be in this trade right now. I mean, I don't have a problem with that. That is a strategy. We're looking at the potential for this to carry to the upside. The risk reward was pretty good. And, if you have a stop here underneath that red bar and you take a small loss, I mean, that's a part of the game. It's kind of tough to say because, we really don't know. We're trying to break out here, but there hasn't been enough follow through. We could see another bar coming back up through, say tomorrow we push up back up through this red line and we see some more follow through. It's very, very possible this trade will work out. But, you got to use a stop. If you took this trade, if it comes back down through, you got to be aware of that. The other thing I think I want to mention, I want to go back to the daily chart because I want to point something out. Here's what I've done is this is the bar chart. I've taken all of everything off the chart, but I have some color coding. The red bars are where you have a narrow range bar, and that would be the narrowest bar based on the range. It would be the narrowest bar of the last 7. And then the kind of the light colored bars like yellowish or tan colored, are the widest range of the last 7 days. So it's comparing today's bar to the last 6 or 7 and saying, okay, am I the widest range or am I the narrowest range of that during that period? And if that's the case, then you get color coding. And so I just wanted to point out, when you break out, I don't want to see a breakout that looks like this. So I'm just putting this trend line in place. And we just took out these highs, and we mentioned that if it broke out, you know, we should see a move to the upside. But look at what it was. It was a narrow range bar on the breakout. It was a tiny little bar. There's no follow through. And I really don't think you're going to see, if you're going to break out or break down, you're not going to have this 1 hour bar that has no follow through to the downside, or the 1 hour breakout that has no follow through to the upside. You're going to see a strong move that has follow through. And, you know, if we go back and look at the S&P when it really turned off the low, look at this breakout. So there was a trend line in place, and when you came through, you did it on a gap, and it just continued to go to the upside. That's the type of price action you really want to see. If you get a single bar and it doesn't have any width to it, there's no strength to it, there's no expansion to the bar, I don't really view that as being all that strong. So I just thought I'd make mention of that. If you look at, so if we were to go and look at this specific bar and look at that potential breakout. Now let's look at a different stock. Let's look at Spotify, which just broke out just a few days ago, and that had wide range on the breakout bar. And if we zero in or zoom out a little bit, you can see that this was a really key area that it was taken out. So it was a really nice breakout. And that big bar is what you're looking for on a breakout. You don't want to have a breakout with a tiny little bar that doesn't have any follow through. You want a breakout bar that's got some real size to it, preferably with volume. I don't have the volume up right now, but this is really the type of price action you want to try and find. So I'm just going to show you something. If we look at, look at these are specific examples of how to look at narrow range bars. So if we've gone through a consolidation on the first chart on the left, you've gone through a consolidation, you're moving sideways, and then you try and break out. It could be a key level. It could be the level like we're trying to take out here at 2950 on the S&P. If you don't have a big bar associated with the breakout, and this is a narrow range bar, that little green bar is just a tiny little narrow range bar, that is really not the type of pattern I'm looking for on a breakout. And then on the right, you can see the breakdown pattern, and you have a tiny little narrow range bar to the downside. That is, again, that is just not the type of pattern that you're looking for. Now, like the gap pattern, I'm showing the black area, the bar is actually the black area with the green inside, and I've filled in the gap area because I want to show you that when you gap up like that, it's not really a narrow range bar. It's a big elephant bar to the upside, a big strong green bar to the upside, because you're showing real strength on a breakout. So I would view that as a very bullish sign, not a narrow range bar on the gap up. If we go and we look at what a real breakout looks like, it would be this first bar, the big green bar coming out of a consolidation area. That's really what we're looking for when we break out. If you do the narrow range bar on a breakout, you're going to need more follow through. I mean, it's okay. It's not necessarily a sell if you have a narrow range bar when it comes to the breakout, but you want to see this type of price action at some point, some type of a wide range move. And then if you look on the right, if you make a big extended run to the upside and then get a wide range bar, that's actually more of a sell signal. So you got to know where these wide range bars are coming from. If there's two different types, one is on a breakout where you're kind of igniting a new move, and then there's one where where it happens after a long run to the upside or a prolonged move to the upside. And if you get a wide range at that point, then you're actually looking to probably be a seller. Let's go in. I'm trying to keep this fairly short. I'm going to go talk about this NVIDIA trade. So we did NVIDIA back. If I go and let me pull up this chart. So if we go and look at the break of this downtrend line, that coincided with the break when the market was breaking its downtrend line that I just mentioned a few minutes ago. And so we actually bought this stock. If you look at it was one of the strongest stocks out there. If you look at the weekly chart, it didn't even break its 40-week. The 18-week and the 40-week were both rising at this point, and you got a really deep oversold reading. And when it took out this bar, this weekly bar, it had made lower high, lower high, lower high. And if you notice, you took out the high of that bar. That was really where we got long, and it happened to coincide with where the market was turning up, breaking its downtrend line. So at this point, you put our entry is right about here, and I've kind of marked this on the side so you can see what's taking place. Our entry's here. We put a stop in. We usually use a specific money management stop, so it's kind of in the middle of this bar, but we're giving it plenty of room between the entry and the stop. And if you look at the difference between the high, or I should say the entry and the stop point, that is really the distance is what I would call R, how much we're risking. And that is it plays a pretty big role in how we take profits. So if you look at what took place, the stock made a really nice move at 1R, meaning the distance from here to here is 1R. Once we made 1R on top of our entry, we took a piece off. We actually took like a quarter of a profit. A lot of this is variable. It's a personal thing. I'm giving you a specific example of how you could take profits. So this 1R is the first entry, and then when that took place, we took a piece off so that if the stock ended up turning back down, we would have taken a small profit on the upside and maybe taken a small loss on the downside. It would have probably been a break-even trade overall. Once we reached 2R, so once this red arrow was reached up here, now all of a sudden we're looking at taking the stop point and moving it to a break-even level. So once we do that, now all of a sudden we're in a pretty good position because we can't lose on the balance of the position, and we've already taken a small profit. Now, typically where we get to 3R is where we're going to take another profit. But in this case, the stock actually, we took profits at this next red arrow. And the reason is the stock's getting ready to announce earnings, I think sometime in the next 24 hours. And so we don't, in this situation, I've given you some kind of guidelines here on profit taking. We err on the side of caution when it comes to earnings. If a stock's made a big move like this, we're probably going to be more inclined to take we took some more profits off the table, and we've got the stop at a break even. We're going to give it some room. Now, this is how I would trade looking at a trend trade, not necessarily something that is a short-term trade. But you want to follow a predetermined plan. So at 1R, we do something. At 2R, we do something. At 3R, we'll do something else. And you want to have a strategy like this that you're going to follow. You don't want to get too emotional. If I go over and look at the daily bars, we had a lot of big red bars to the downside, a lot of things that could have shaken you out if you don't have a predetermined plan. So I definitely recommend that. And there's two things that I would tell you about profit taking. Number one is when it comes to trend trading, have a strategy where you scale out and trail. Scale and trail. As it moves in your favor, keep trailing the stop underneath, and keep scaling out as you have profits that are available to you. With short-term trading, it's a different strategy. I would really look at it like this. I would say I would look to buy when there's contraction and sell when there's expansion. So I mentioned the expansion bars and the contraction, the tighter bars, the smaller bars. But when you look for breakouts, you would look for, a breakout of this consolidation pattern. And then when the move gets extended away, or you make a pretty big move in a short period of time, I would look to be taking profits. So anyway, this is the types of strategy that I think I'd want you to try and implement. If short-term trading, you want to take profits quickly, it's a lot. You're a lot more. It's a lot more beneficial to you to take profits quickly when you're short-term trading, and when it comes to longer-term type patterns, I would be more inclined to try and let profits run a little bit. Be a little bit more, judicious about how I take profits. So anyway, I hope this was helpful. Please hit the subscribe button, and we'll talk to you soon.